Okay, so you're thinking about starting to invest. That's awesome.
Hmm?
And you want to understand like the whole process,
Mm-hmm.
right? All the important concepts.
Okay.
Well, we've got a ton of great resources to like totally break it down for you. And I got someone here who's incredible at explaining all that like financial mumbo jumbo,
It's great to be here.
making it all make sense.
Investing can definitely seem like a different language, but
Right.
once you get the basics, it becomes way more clear.
Totally. You know, one thing that really stood out to me from like all these articles and books is that they all stress how important it is to prepare. Like
Hmm.
before you even start thinking about buying stocks or bonds, you've got to get your finances like in order,
Absolutely.
like your personal
Right.
finances.
It's like building a house.
Okay.
You wouldn't start with the roof.
Right.
You need a solid financial foundation.
And they all say that starts with an emergency fund. But one source actually said, like straight up, that you should have a fully funded emergency fund before even paying off things like student loans,
Oh, okay.
which kind of surprised me.
Yeah.
Can you explain like why that is?
So it might seem kind of counterintuitive, but it's all about reducing risk.
Okay.
Like imagine you're super focused on paying off your student loan,
Right.
but then bam, your car breaks down, or you have a huge medical bill,
Yeah.
and if you don't have that emergency fund, you might have to like put it all on a credit card,
Oh, no.
which has crazy high interest.
Right. And that could like set you back even further than the student loans were doing, right?
Exactly.
That's a really good point.
It's all about staying out of those high interest debt traps.
Yeah, those are scary.
Yeah, those can really mess up your progress.
Speaking of high interest, though, we got to talk about debt,
Yeah.
existing debt. I mean,
Oh, absolutely. High interest debt, stuff like credit card balances, that's like a huge drain
on your money.
on your finances. Yeah. Like imagine running a race, but you've got a weight tied to your ankle.
That's right.
Let's say you're earning 7% on your investments, which is great, but you're paying 20% interest on your credit cards.
Oh, ouch.
Yeah, you're actually losing money.
Wow, that's a really good way to put it.
So getting rid of that high interest debt, that's a priority.
Okay, so once you've got, that emergency fund built up
Yeah.
and you've tackled that high interest debt, then all these sources start talking about risk tolerance.
Ah, yes.
So what exactly does that mean when it comes to investing?
Basically, it means how comfortable are you with the idea of maybe losing some money in the short term,
Okay,
but with the potential to earn a lot more in the long run.
got it.
So it's really personal. There's no right or wrong answer.
But one article said that those traditional risk tolerance quizzes can be a little misleading because they focus on like hypothetical situations,
Right.
not how you'd actually feel if the market tanked,
Yeah, there's some truth to that. It's easy to say I'm cool with risk.
when it's not real money.
Exactly. But when your investments actually drop, it can feel very different.
Totally.
So you got to consider not just your financial capacity for risk, but also your like emotional resilience.
Right. How do you figure that out?
Well, there are a few things to think about. Your age is a big one,
Okay.
and your time horizon.
How long you plan to invest?
Right, exactly. And one source specifically said that, younger investors, they might want to put more of their money into growth stocks, those are stocks from companies that have a lot of potential for growth,
Okay.
but they can also be more volatile, meaning their value goes up and down more.
Risky, but potentially more rewarding.
Exactly. And younger investors have more time to recover if those stocks dip.
So they can ride it out a bit.
Yeah, so it could be a good strategy.
Makes sense. And speaking of time horizons, we got to talk about retirement. It's like a big focus in all these resources. They all talk about 401ks and IRAs.
Yes.
Can you give us like a clear explanation of what those are and why they're so important?
So these are special retirement savings accounts that have some really awesome tax advantages.
Cool.
A 401k is usually offered through your employer.
Okay.
And the best part is sometimes your employer will match your contributions.
Wait, really?
Yeah, like for every dollar you put in, they put in a certain amount too.
So it's like free money.
It's basically free money.
That's amazing.
Yeah, it's a great deal.
One article said it was like getting a guaranteed 100% return
I love that. It's such a good way to put it.
right off the bat.
You can't beat that.
No kidding. Okay, so once you've got all those basic things figured out, like the emergency fund, managing your debt, understanding your risk tolerance,
Mhm.
and setting up those retirement accounts, how do you actually start investing? The sources talk about two main ways: DIY investing and working with a financial advisor.
Yeah, those are the two big ones.
So what are the key differences between them?
So with DIY investing, you're in total control. You do all the research, pick your own investments.
Manage everything yourself.
Exactly. It can be really empowering, but it takes time and effort.
And you kind of have to know what you're doing.
Right.
Yeah, you need to be pretty financially savvy.
So it sounds like DIY is great for someone who really loves diving deep into research
Totally.
and managing their money, like they want to be hands-on.
Absolutely. But for some people, it can be a little overwhelming.
And that's where a financial advisor comes in.
Exactly. They can help you make a plan, manage your portfolio.
Give you advice based on your goals and risk tolerance.
Yeah, it's like having a co-pilot on your investing journey.
I like that.
They can help you navigate everything.
Okay, so whether you go DIY or work with an advisor, all of the sources, like all of them, really stress the importance of diversification.
Yeah, diversification is key.
Can you explain what that means when we're talking about investing and why it's so important?
Basically, it means spreading your investments around. Like, don't put all your eggs in one basket.
Instead of just buying one stock or one type of investment, you diversify. You spread your money across different types of assets, different sectors, different geographic regions.
So if one investment does poorly, hopefully the others can kind of balance it out.
Exactly. It helps reduce your overall risk.
So don't put all your eggs in one basket. Really applies to investing too.
Big time.
Can you give us like an example of what a diversified portfolio might actually look like?
Sure. So a diversified portfolio might include a mix of things like stocks,
Okay.
bonds, real estate, maybe even some
Those
commodities.
are commodities.
Things like gold or oil, raw materials.
Got it.
And then within stocks, you could have some large cap stocks. So those are from big established companies.
Like Apple or Google or something.
Exactly. And some small cap stocks, those are from smaller companies that might have more growth potential.
And higher risk, maybe.
Potentially, yes. And then you might also have some international stocks.
So you're not just limited to the U.S. market.
Right, exactly. The exact mix of all those things depends on your risk tolerance and your investment goals.
So it's all about finding that balance, making sure you're not too exposed to one thing.
Yeah, spreading the risk.
And lastly, the sources talk about the importance of monitoring your portfolio. It's not a set it and forget it kind of thing, is it?
Not at all. Monitoring your portfolio is super important.
What does that involve? Exactly.
And basically, you need to regularly check how your investments are doing.
Okay.
Make sure they're still in line with your goals and your risk tolerance.
And if they're not, you might need to make some changes.
Yeah, sometimes you got to adjust things.
How often should someone be checking their portfolio?
That depends on you. Some people like to check it monthly. Others do it quarterly or annually.
Okay.
It's about finding what works for you and staying informed.
Got it. And before we wrap up, I think it's important to emphasize something that all of the sources mentioned. Investing always involves some level of risk.
Yes, absolutely.
Just because an investment did well in the past doesn't mean it'll do well in the future.
Exactly. There are no guarantees in investing. You have to be prepared for ups and downs.
You got to have a long-term perspective.
Yeah, be patient and stick to your plan.
So as our listener starts their investing journey, what's like the one piece of advice you'd give them to help them take that first step?
I'd go back to the beginning. Build that emergency fund.
Yes.
That's the foundation for everything else.
It gives you security and peace of mind.
Exactly. Once you've got that in place, then you can start exploring investing with more confidence.
Awesome advice. And listener, keep digging into those resources you've got. They're packed with great info, and that'll help you along the way. Thanks for joining us for this deep dive into investing basics. Hope you found it helpful
My pleasure.
and maybe even a little exciting. Until next time, happy investing.